everyone, welcome back to Financing Simplified. I'm your host, Anthony Venuto, brought to you by InTouch Mortgage Solutions. And like our tagline, Financing Simplified, we do our best to try and simplify the financing process. And on this episode, I want to talk a little bit more about interest rates and sort of what impacts interest rates at a very high level. You can go down a serious rabbit hole when it comes to how interest rates are calculated, projections, forecasting. Obviously, there's guys that are paid big money with major PhDs, economists, like at the Fed and as well as the Bank of Canada. But even these guys get it wrong most of the time. And obviously, it is a very challenging conversation. And a lot of times we'll get calls from clients saying, Anth, how are or fixed rates are going up? You made a post, or how do variable rates work? Or sometimes they'll say, hey, fixed rates or rates are going up. And they're like, well, no, the Bank of Canada is not meeting until September. How are they going up, right? So there are some differences when it comes to how we look at interest rates. Obviously, for simplicity, the 5-year government bond, the 5-year Canada bond, is generally a great barometer for where fixed rates are headed. And as there are inverse reactions in bonds as prices change, and so do yields and coupon rates. And without getting into too much of that stuff, what's important to understand is if you're looking at a treasury, or sorry, a bond, the U.S. would consider it a treasury, you definitely see as the price of that goes up, so do the bank's rates and how they calculate fixed rate mortgages. So just over the past little while, we've seen a huge surge in the bond prices. We were sitting, I believe, in May around 2.8, and now we're hovering we just touched on at the time of filming this video, 4%. And over that course, we've definitely seen interest rates jump up significantly, going from, some rates below 5% to now rates that are all with a 6 in front of them pretty much, unless you're an insured or insurable product. So it's important to understand that there is a big correlation. Now, what drives the bond prices, right? Well, there's bond traders, there's people that make predictions and sort of forecast on what's going to happen. And this is the volatility part of it. And generally, the two worlds, in my opinion, are separated to some degree. Obviously, there are things that are commingled. So when the Bank of Canada talks, it's very... their sentiment, what they're conveying, what the message is, obviously is digested by these people that trade in bonds, and obviously the stock market and all these markets make assessments, and they trade based on what they think is going to happen. Obviously with the U.S. Fed raising rates, obviously that's going to trigger things to move in the markets. And that obviously has an impact on fixed rate mortgages, right? This is the way it is. Now, generally, if the Bank of Canada increases their policy rate or their overnight lending rate, well, that impacts directly variable rate or prime with banks, right? So that's how most clients that have a variable rate mortgage, a home equity line of credit, maybe loans that are based on prime, well, that automatically moves with the Bank of Canada. Or fixed rates are a little bit different, but it can leak in there where if the markets start to see that the Bank of Canada may want to increase, maybe for September when they meet, I believe it's on September 6th is the next time right after the holidays, that the Bank of Canada is potentially going to hike 25 basis points. Maybe they're not. And how the markets react to the sentiment, right? So this is the same thing. When Jerome Powell, the head of the U.S. Federal Reserve, comes out and has a conversation, people are trying to dissect basically what that word means or what he's trying to say by doing this and what's the report telling us. And that's what they're looking at. They're looking to see what he said and also, more importantly, what he didn't say or what they did not say, right? So these are all the nuances when it comes to barometers and trying to figure out. And as you can see, it's a guessing game at best for most of us. It's a hypothetical, it's a hypothesis. You can make a thesis saying, hey, I think based on X, Y, and Z, the Bank of Canada and the Fed's going to do this. That's going to translate to this. But obviously, we are in a very volatile situation right now when it comes to interest rates. We are our own economy, but obviously, the old adage is if the U.S. sneezes, Canada catches the cold. And we are definitely very closely related to what happens. And I think we're sort of seeing this, in my opinion, happening and playing out right now. The U.S. Federal Reserve just raised their policy rate. The Bank of Canada raised first. We're almost in lockstep, in unison. There's a lot of things that are playing in behind the scenes as well, right? exchange rate, right? What's happening with the U.S., the greenback, the U.S. dollar to the Canadian dollar. Because obviously if there's too far of a gap between these two currencies, then you could be potentially importing inflation. But if the Canadian dollar gains too much strength, well, then, there's obviously some ramifications of that. And some things could be like, for example, the cost to acquire U.S. goods, biggest trading partner, we're paying more for U.S. products. Obviously, you're inflating, inflation kicks in. But if our economy is too strong, well, then obviously what happens to our exports, right? Like that, there's always these questions. And I'm not, as I said, an economist by any stretch of the imagination, but it's important for viewers to, sort of do their own research and understand what is actually happening, because there's so many different components that can move and shape an economy. And literally the past few years have been a testament to that. We've seen how the pandemic, how supply chains issues can disrupt the shipping lanes to get these products into the Canadian stores, food, energy, obviously external factors like globally what was happening with Russia and Ukraine. Obviously, all these things, what's happening now with China, is China slowing down, large economy. These are all things that are so interrelated nowadays with technology that we can move at the speed of light. Information can be digested so much more quickly. Markets can move so quickly just based on literally the smallest thing. Well, the world standard was the U.S. dollar, still is to some degree the U.S. dollars. Yes, there's other countries and other nations forming their own currency. Obviously, this could have an impact. I'm not 100% like on how this could play out. Obviously, I have my reservations on where we could be going. Obviously, predictions is shitty business, right? Making predictions is not what we like to do. We like to try to look at the best possible facts, make the best assumptions that we can, obviously, on the information that we have. As far as the currencies are concerned, obviously, yeah, 100% that could definitely play into what happens with the U.S. More importantly, I think, obviously, the election's coming around the corner, obviously, as we start to prepare for that. We had a lot of clients that obviously wanted to get a pre-approval, and they did it at specific points. I mean, people are looking to buy home at different points in their life cycle, in the way that they're seeing their family grows, the family expands, the need to purchase a home changes. So we'll get clients that will want a pre-approval. And obviously most pre-approvals are good from anywhere from 120 to 130 days. That is for the rate hold, right? So most clients will ask me and say, well, what's the pre-approval good for? And I'm like, well, pre-approval does is if done properly, I should say, you're gathering all that sensitive documentation, your job letter, your pay stub, your T4s, if you're salary or hourly, if you're self-employed, you're looking at your T1s, you're looking at the financials, all this information. Some of those items don't actually change over the course of a few months or a few weeks. So some of that information is still valid. So we always say to our clients, yes, the pre-approval is good for the rate hold. But obviously in this environment right now where interest rates are going up, yes, requalifying is super important. The minute that rate expires, right, that's the way the qualification is set. So if you're getting a rate at the time, let's say of 5.14%, and it expires, let's say August 16th, okay? If the transaction isn't completed by that date, that specific August 16th date, then you lose the rate and obviously the qualification on that mortgage amount. So if you were pre-approved for $600,000 at 5.14% plus 2%, which means you're at 7.14% qualifier, and now the rate goes up to, let's say, 6.5%, now you're qualifying at 8.5%. So maybe you don't qualify for that same $600,000 anymore.
But you're locked in.
But if you're getting the pre-approval with a certificate from a lender and from a broker,
that means that it's going to be honored even if the Bank of Canada goes up.
Absolutely. Well, with the Bank of Canada, so there's this conversation. If you have a fixed rate component, it's locked in. That rate is locked in until the date expires based on the conditions, obviously, of appraisal and conditions. As long as the credit is the same and the income is the same, nothing happens, they don't lose their job, then it is 100% still valid. But then, obviously, if the Bank of Canada makes their changes, let's say you got a pre-approval, you want it to go in a variable rate product. Well, you can't hold the Bank of Canada policy rate, right? That's just the nature of the Bank of Canada. Prime lending moves, it shifts, there's no hold. What clients would be locking in with a pre-approval would be the discount rate. So let's say prime is at 7.20% and they have a discount of, let's say, 1%. That means they always get the 1% off the prime rate. So if prime goes to 8.2%, now they're at 7.2. If it's at 7.2 and they have the 1% prime or 1% discount, then they would be at 6.2. Some banks may hold off 24 to 48 hours, right? Because they might try to get some of that access business that was supposed to go that way. And we're still getting that client that comes into us like 24 hours later saying, I want a pre-approval, and we ship it off to them because they haven't moved the rate. But it's literally at the bank's discretion. But most banks with the pricing in bonds, just to go first full circle, as they see them go up, they definitely try to move in lockstep with most of the banks. If you want to know more about those particular types of products and variables, and we'll have more discussions on that, stay tuned to our Financing Simplified podcast, and we'll be talking more about this on another episode. But once again, you can find us on all social media. We're on YouTube, we're on Instagram at @A_Venuto, and on YouTube at InTouch Mortgages. And we'll leave the video here, wishing everyone a great day, signing off, and thanks again for clicking. We'll see you next time.